Mr. Bob Iaccino. He's the founder and chief strategist at Path Trading Partners. He's standing by to discuss today's release and market reactions to it. Bob, thanks for coming on the show today. I imagine there's at least a dozen places you could be right now watching this number come out, and you chose to be here with us. We appreciate that. Let's begin by taking a look at the actual number. Again, coming in a little bit higher than expected. Can you talk to me about what stands out, what jumps out at you when you look at these headline numbers?
Well, two things jump out. Number one, we had 11,000 revisions lower in the last 2 months. So net 11,000 lower in April and May, made up in dramatic fashion by the headline number beating by quite a bit. I mean, some of the guesses I saw were around the 160,000 jobs range. So this over 200,000 number is pretty significant. You got wages growing, but still growing at that very muted level, that 0.2, 0.3 month over month. That 3.1 year over year number is a good number. You'd expect to see it closer to 4 with the longest ever economic expansion in U.S. history. We'd expect to see it growing a little bit more. And this goes back to the sort of structural deflationary economy that it seems like we're in. Every single sector added jobs. Retail's the only one that lost jobs. That's the 5th consecutive jobs number in a row that we've lost in retail, which again fits that structural narrative of those sort of lower paying, underperforming jobs kind of going away with the internet economy. And then this kind of bumped the dollar up a little bit, which was a little bit surprising to me. I don't think this number is strong enough to take the Fed out of the picture. The 4-week moving average on jobs, 171,000. But you look at that uptick in labor force participation rate, that's an interesting sort of indicator of confidence of those that feel kind of disaffected and disallowed from the current economy going back into the labor force. That number hasn't crept up in almost a decade, and it's starting to now. Sort of 2 out of the last 3 jobs number, we've seen labor force participation rate tick up.
Bob, you mentioned you don't think that this number is enough to tip the scales in terms of the Fed for that dovish stance. I'm noticing that the yields are inching up a bit here right now as Treasury futures come off a little. I mean, talk to us about, for the most part, this is a kind of a weird number coming in the day after a holiday, the day before the weekend, a holiday weekend. I'd imagine it could be till Monday before we actually really see reaction to this number, or at least some sort of digestive type response to.
Yeah, I would totally agree with that, Ben. And here's the thing, those inching up of rates, the little spike we've seen in the dollar was already up on the morning. I think that's characteristic of short covering rather than anything else, because that is what you would see. This is not a holiday shortened day, but it's holiday shortened in terms of the volume we're going to have. Ben, you were down here back in the day when we would have days like this, and people would just kind of come in for the morning, right, work the number, and then kind of take off. Yeah. It's that same sort of mentality. Okay. This is not a number that blows anything out of the water, so I think that's going to be the case. You're going to see the volume lighten up a little bit. And then again on Monday, you know, this to me, when you've seen the probabilities on, say, the CME Fed Watch tool move from sort of a 10-12% probability of a 50 basis point cut at the July meeting, go down to a single-digit probability of that, you still don't see probability of rates staying the same creeping up at all. You've still got 100% probability of some sort of rate cut at the July meeting. We've seen the 25 basis point rate hike probability inch up. This is the kind of number where I think that continues, and it sort of takes that 50 basis point rate hike out of the rate cut rather. Again, I still can't get used to saying rate cut. It takes that rate cut out of the picture, that 50 basis points, that sort of shock and awe out of the picture, but it does not take the Fed out of the picture, in my opinion.
Yeah, Bob, you're not alone in terms of shifting from rate hike to rate cut. I've made that mistake a couple times myself on the show. Bob, let's shift on over to discuss some of the currencies, some of the recent price activity that we've been seeing. One of the reasons that I keep saying that the dollar's been able to perform this levitation act, as I've been calling it, that we've seen as rates have been coming off, the dollar remains very strong, is some of the weakness we've been seeing in the euro currency and the British pound. Euro today, I think it was to a 3-week low. You've got the British pound also nearing a multi-month lows. Talk to us about what you're seeing there in terms of some of the weakness. I'd imagine, again, the factory orders, the disappointing numbers out of Germany today and this week, for the most part, haven't helped.
Yeah, I would agree with that. I mean, so two things. We're starting to come to the conclusion of the UK Prime Minister fight. We're going to know sometime in the next couple of weeks whether it's Boris Johnson or not. If it's Boris Johnson, there's a higher probability of a hard Brexit. At least that's the way the analysts are looking at it right now. I don't live in the country. I don't see it day to day. But again, a hard Brexit isn't as bad as the confusion that comes with not knowing sort of with any certainty what's going to happen. But you're likely to see easing by the Bank of England if it's Boris Johnson, maybe not right away, but maybe quicker and more aggressive than the US Fed. Same thing in the EU. We've got the Christine Lagarde taking over the ECB now. She's viewed as a dove. A strange choice. The French and the Italians are viewed by the EU community as being more dovish than, say, the Germans. So that was more of a relief that it was going to be Christine Lagarde over anything else. That kind of leaves us in a situation where the sterling and the euro, which are two of the larger components of the dollar index in terms of what currencies is in the basket versus the dollar. And you're absolutely right when you call it that. There's always two parts to a currency trade, right? Is it the dollar is strong because the fundamentals of the U.S. are strong, or is the dollar is strong because the fundamentals of the U.S. are slightly stronger than weak fundamentals in, say, Europe? And that seems to be the case. Europe, their economy is falling a lot quicker than the U.S.'s is.
All right, Bob, we're going to let you get out of here. I'm sure you've got a lot to take care of here this morning and get to after that number. Really appreciate you giving us part of your day, and we look forward to seeing you back here in the near future. Traders, that's Bob Iaccino, the founder and chief strategist of Path Trading Partners.